Let me present Chapter 5, devoted to hospitalization insurance, from the course Actuarial Foundations for Life and Health Insurance. The purpose of the chapter is to show how a product that may look close to non-life health insurance can be treated with the tools of life and health actuarial mathematics. Hospitalization insurance is not only about counting annual claims, it is about following the insured over time, distinguishing the periods spent outside hospital from the periods spent in hospital, and translating this dynamic history into premiums and reserves. The chapter is therefore a bridge between the single life model introduced earlier and the more general multi-state framework used for life and health insurance contracts. We will move from product motivation to stochastic modeling, then to premium calculation, reserving, estimation of transition rates, and finally numerical illustrations based on Belgian portfolio data. The presentation is organized around 5 blocks. We begin with the executive summary, which gives the main message of the chapter. We then motivate the product by discussing the limits of a classical annual aggregate loss view. The central part introduces the multi-state hospitalization model, first through the states and transition rates, then through transition probabilities and stay probabilities. The pricing and reserving part explains how premiums, benefits, and mathematical reserves are expressed in this framework. Finally, the empirical part shows how transition rates can be estimated from exposure data and how simulation is used to evaluate deductibles and level premiums. This chapter develops a continuous time actuarial model for hospitalization insurance. The key idea is that the insured is not represented only by an annual number of hospitalizations and a collection of costs, but by a process that records the health state occupied over time. This is essential because hospitalization benefits depend on the state of the insured and, in many contracts, on the duration already spent in that state. The model therefore follows the insured dynamically, which is more consistent with products where premiums are often level and where the insurer cannot simply revise the contract every year. The main modeling step is to replace the usual frequency and severity approach by a finite state stochastic process. The process allows repeated transitions between active status and hospitalization, and this repeated movement is exactly what creates the need for a reserve mechanism. For women, the chapter distinguishes ordinary hospitalization from pregnancy-related hospitalization. This distinction is not cosmetic. It makes it possible to represent childbirth risk, waiting periods, and the strong age dependence of premiums between the 20s and the early 40s. The framework then supports all core actuarial quantities. It gives risk premiums for annual coverage, level premiums for long-term coverage, mathematical reserves by state, and numerical procedures for clauses such as annual deductibles and waiting periods. We now turn to the product motivation. The aim is to understand why hospitalization insurance cannot be reduced to a simple static claim model. The contract covers an event that is familiar to everyone, but its actuarial treatment is subtle because hospital costs are shaped by duration, medical inflation, age, sex, childbirth, and contractual clauses. This section clarifies the economic content of the insurance coverage and explains why the state-based model introduced later is not just a mathematical refinement. Hospitalization insurance is designed to cover expenses that remain payable by the insured after statutory health insurance has intervened. In countries such as France and Belgium, public or statutory schemes reimburse part of the cost, but the residual bill may remain large. The insured may have to pay for hospital accommodation, a private room, medical and surgical fees, medication, medical devices, ambulance transport, or even accommodation costs for a parent of a hospitalized child. These examples show why private coverage has developed around hospitalization risk. The benefits may take 2 broad forms. Under an indemnity contract, the insurer reimburses actual costs, possibly up to a contractual ceiling after statutory reimbursement. Under a lump sum contract, the insurer pays a fixed amount per day of hospitalization or a fixed benefit after a qualifying stay. The French example discussed in the chapter illustrates this second logic. Benefits may begin immediately after an accident, but only after a waiting period in case of illness. The actuarial objective is complicated by several clauses. Policies may include annual deductibles, waiting periods for childbirth, age and sex-dependent premiums at inception, and level premiums over the duration of the contract. Women often pay higher premiums because of pregnancy-related hospitalizations. Since the insurer may be unable to cancel the policy after a few years, underwriting and reserving must be consistent with long-term risk. The pricing problem is therefore not just to compute an average annual cost, but to price and reserve a dynamic product shaped by frequency, duration, age, sex, and contract design. The slide recalls the classical annual aggregate loss representation. Equation 5.1 writes the total annual cost as the sum of the costs of all hospitalizations occurring during the year. In that representation, the pure premium is obtained by multiplying the expected number of hospitalizations by the expected cost of one hospitalization under the usual independence assumptions. This is a natural non-life insurance starting point, but it is too limited for the product studied here. The first difficulty is that hospitalization frequency and severity are not independent in any meaningful actuarial sense. The cost of a hospitalization is closely related to its duration. At the same time, the number of hospitalizations observed during a year also depends on the time spent in hospital. A person hospitalized for a long period is not exposed in the same way as an active person who remains outside hospital. Separating frequency and severity therefore hides an important time dimension. The second difficulty is the age profile of the risk. Hospitalization risk generally changes with age, and in many portfolios it increases sharply at older ages. If premiums are level, early premiums may exceed current annual risk, and later premiums may be insufficient. The insurer must then build reserves during profitable periods and use them when the annual risk becomes higher. The insurer must follow the health state of the insured over the full contract duration, not only aggregate yearly claims. The next part introduces the multi-state hospitalization model. The modeling philosophy is the same as in earlier chapters. Define a small number of states that summarize the relevant insurance status of the policyholder, specify the possible transitions, and attach cash flows to states and transitions. What changes here is that the process can move back and forth between active status and hospitalization. There is no absorbing death state in the simplified model, and duration matters because deductibles and benefits may depend on the length of the stay. The figure represents the three-state structure used for women. The insured begins in the active state, denoted by E0. From this state, she can be hospitalized for a reason other than pregnancy, represented by E1, or she can be hospitalized for pregnancy-related reasons, represented by E2. From ordinary hospitalization, the process can return to the active state. From pregnancy-related hospitalization, it can also return to the active state. There is no direct transition between the two hospitalized states in the graph. This separation is important for actuarial reasons. For men, or when the cause of hospitalization is not distinguished, a two-state model with active and hospitalized states may be sufficient. For women, childbirth and pregnancy-related hospitalizations create a specific risk profile. They are concentrated over a limited age range and are often subject to waiting periods. A contract may, for example, cover pregnancy-related hospitalizations only after 9 months from policy inception. A single hospitalized state would make it difficult to represent this clause correctly. The figure should also be read dynamically. The insured may experience several stays over the contract duration. A hospitalization begins with a transition out of the active state, and the duration of the stay is governed by the return intensity to the active state. The model therefore captures both the risk of entering hospital and the length of time over which benefits may be paid. This is the central reason why a multi-state process is more suitable than an annual frequency-severity model. The insured history is represented by a stochastic process taking values in the 3 states shown previously. At policy inception, time is set to 0, the insured is active, and her age is denoted by X. At any later duration t, the process indicates whether she is active, hospitalized for a non-pregnancy related reason, or hospitalized for pregnancy-related reasons. This state information is already enough to determine whether premiums are due or benefits may be payable. However, the state alone is not sufficient for many hospitalization contracts. The chapter therefore introduces a second process, the occupation duration process. This process records how long the insured has already spent in the current state. If the insured is active, the duration measures the time since the end of the last hospitalization or the time since inception if no hospitalization has occurred. If the insured is hospitalized, it measures the length of the current stay. This duration variable is crucial for contractual clauses. A daily benefit may start only after a time deductible. A maximum reimbursement period may limit the total number of compensated days. A pregnancy-related stay may be covered only if the admission occurs after a waiting period. The pair formed by the current state and the current duration therefore contains the information needed to value the contract. The model remains Markovian in spirit, but it is rich enough to track the practical features of hospitalization insurance. The 4 transition rates describe the local dynamics of the model. The first rate is the instantaneous intensity of moving from active status to ordinary hospitalization at age X plus T. It measures the immediate risk that a woman who is currently not hospitalized enters hospital because of illness, accident, or any cause other than pregnancy. It is a rate, not a probability, and it governs the short-time behavior of the process. The second rate is the instantaneous intensity of leaving ordinary hospitalization and returning to active status. This rate determines the distribution of the length of ordinary hospital stays. A high return rate means short stays on average, whereas a lower return rate means longer hospitalizations and therefore potentially larger benefits. The third rate is the intensity of entering pregnancy-related hospitalization from the active state. The chapter assumes that this rate depends on age, but not on the date of a previous pregnancy-related admission. This is a simplification because biological constraints imply a minimum delay between pregnancies. From the insurer's point of view, the assumption is prudent because it may allow more pregnancy-related transitions than can occur in practice. The fourth rate is the intensity of leaving pregnancy-related hospitalization and returning to the active state. Together, these 4 rates determine both the frequency of hospital admissions and the duration of stays. They are the dynamic analogues of the frequency and severity components, but they are embedded in a coherent state process. The slide displays the annual generator of the 3-state Markov model. I will not read the matrix entry by entry, but its structure is important. The off-diagonal terms are the transition intensities between states. The first row contains the 2 possible exits from the active state, ordinary hospitalization and pregnancy-related hospitalization. The second row contains the return from ordinary hospitalization to active status. The third row contains the return from pregnancy-related hospitalization to active status. Direct transitions between the 2 hospitalized states are not allowed in the generator. The diagonal terms are chosen so that each row sums to 0. This is the standard structure of a continuous time Markov generator. The negative diagonal entry is the total exit intensity from the current state. For the active state, the total exit intensity is the sum of the 2 admission intensities. For each hospitalized state, the only direct exit is the return to active status. The chapter assumes that these transition rates are constant within each completed year of age. This assumption is actuarially convenient because portfolio data are typically organized by integer ages. It also makes it possible to compute annual transition probabilities from the generator using matrix exponentials. Transition probabilities describe the probability of being in a given state at a future time, conditional on the current state. The equation on the slide expresses the forward system associated with the generator and states that the transition matrix over a period of length t is obtained by exponentiating the generator matrix. This is the standard continuous time Markov chain construction. The important point is that transition probabilities are not limited to direct jumps. They specify only the state at the beginning and the state at the end of the interval. All admissible paths between the 2 dates are allowed. For example, even though there is no direct transition from ordinary hospitalization to pregnancy-related hospitalization, the probability of going from one hospitalized state to the other over a non-infinitesimal interval may be positive. The path can pass through the active state before entering the other hospitalized state. For projections over several years, the model multiplies annual transition matrices. This is necessary because the rates depend on the age reached by the insured. A woman aged 30 uses the generator calibrated for age 30 during the first year, then the generator for age 31 in the next year, and so on. The chapter illustrates this numerically for women aged 30 to 32. Using the estimated matrices, the probability of still being active after 3 years from age 30 is approximately 0.998910. This example shows how the local transition rates are translated into multi-year actuarial probabilities. Stay. Probabilities are different from ordinary transition probabilities. A transition probability asks where the process is at the end of an interval. A stay probability asks whether the process has remained continuously in the same state throughout the interval. This distinction is essential in hospitalization insurance because many contractual clauses depend on uninterrupted duration in a state. The formula shown on the slide gives the active state stay probability. Instead of reading the expression literally, its meaning is the following. The probability of remaining active over a period is the exponential of minus the cumulative exit intensity from the active state. Since there are two ways to leave the active state, ordinary hospitalization and pregnancy-related hospitalization, the exit intensity is the sum of the two admission intensities. Similar expressions hold in the hospitalized states with the relevant discharge intensity. These stay probabilities are the natural tools for modeling durations. In a hospital stay, the probability of remaining hospitalized for at least a certain number of days is directly linked to the return to active intensity. This connection is also used in simulation. By inverting the survival function of the stay duration and applying it to a uniform random variable, the actuary can simulate sojourn times in each state. The modeling part now translates into cash flow valuation. Once the process and transition intensities have been specified, the actuary must attach premiums and benefits to the states occupied by the insured. The core principle remains the principle of equivalence. The expected present value of the premiums must balance the expected present value of the benefits on the technical basis. The originality of this chapter is that those expected values are computed along the paths of a multi-state process, with premiums paid only in the active state and benefits paid during hospitalization. Premium payments are represented by a cumulative premium function. The important contractual assumption is that premiums are due only when the insured is active. If the insured is hospitalized, premium payments may be suspended or refunded depending on the contract. In expected present value calculations, this means that the premium cash flow must be weighted by the probability of being in the active state at the payment date. The chapter then incorporates specific hospitalization clauses. A waiting period for childbirth is denoted by gamma G. Pregnancy-related hospitalizations during the initial waiting period are not compensated. This clause is motivated by anti-selection. Without a waiting period, a person could buy the policy immediately before a predictable childbirth-related hospitalization. Time deductibles are also introduced. They define the minimum length of hospitalization before compensation starts, separately for ordinary and pregnancy-related stays. Benefits are described by functions that depend on calendar time and duration of stay. This is a flexible representation. For an indemnity contract, the daily cost is random in reality because it depends on pathology, complications, medical choices, and hospital charges. The chapter uses average daily costs while recognizing that simulation may incorporate cost variability. For lump sum contracts, the benefit rate is known in advance and may be capped by a maximum reimbursement duration. The functions can also include expected medical cost inflation. The slide gives the pure single premium according to the principle of equivalence. I will describe the expression rather than read it. It is the sum of two expected present values. The first part values ordinary hospitalization benefits. It considers all possible future admission times from the active state to ordinary hospitalization, weights each admission by the probability of being active at that time and by the corresponding admission intensity, and then values the benefits paid during the subsequent stay. The second part has the same structure for pregnancy-related hospitalization. This nested structure reflects the timing of the contract. First, the insured must be active up to the admission time. Second, a transition into a hospitalized state must occur. Third, conditional on that admission, the stay may continue for a certain duration and benefits are paid according to the benefit function and the discount factor. The in evaluation therefore concerns the future payments during the stay, while the out evaluation integrates over all possible admission times. A general premium rule must satisfy the equivalence condition. The expected present value of premiums paid while the insured is active must equal this pure single premium. The formula is therefore more than a pricing expression. It shows how the state model decomposes the insurance risk into admission risk, stay duration, discounting, benefit design, and contract maturity. This is precisely the advantage of the continuous time model compared with an annual aggregate loss approach. Mathematical reserves are state dependent. An active insured does not have the same future cash flow profile as an insured who is already hospitalized. The chapter therefore defines a reserve for the active state, a reserve for ordinary hospitalization, and a reserve for pregnancy-related hospitalization. When duration matters, the hospitalized reserves also depend on the time already spent in hospital. Under the equivalence principle, the initial active reserve is zero if the premium basis and benefit basis are consistent. The equation displayed on the slide is the active state component of Thiele's system in the simplified case where benefits do not depend on duration and the childbirth waiting period is no longer active. I will interpret it verbally. The active reserve increases with financial interest and premium inflow. It is affected by the possibility of moving from active status to ordinary hospitalization or pregnancy-related hospitalization. When such a transition occurs, the reserve must jump conceptually from the active reserve to the reserve appropriate for the new state. The corresponding equations for the two hospitalized states include benefit outgo and the possibility of returning to the active state. This system provides a local, differential description of reserve dynamics. It is useful because it explains why level premiums generate reserves. When the level premium is higher than the current annual risk, the reserve accumulates. When the future annual risk exceeds the level premium, the accumulated reserve is consumed. We now move from the theoretical model to estimation and numerical results. The key quantities are the transition rates. They must be estimated from portfolio data, time spent active, time spent hospitalized, and the observed transitions between states. The numerical illustration is based on data from a Belgian insurer, which makes the discussion concrete and close to actuarial practice. The estimation principle is exposure-based. For each completed age, the actuary measures the total time spent in the active state, the total time spent in ordinary hospitalization, and the total time spent in pregnancy-related hospitalization. These are the risk exposures. They are the denominators of the crude transition rate estimators. The numerators are the observed numbers of transitions, from active to ordinary hospitalization, from active to pregnancy-related hospitalization, from ordinary hospitalization back to active status, and from pregnancy-related hospitalization back to active status. The formulas displayed on the slide express this simple maximum likelihood idea. A crude rate is the number of observed transitions divided by the corresponding exposure. This comes from the likelihood of a continuous time Markov process, with constant rates at each age. Time spent in a state contributes an exponential survival term, while each observed transition contributes the relevant intensity. Crude rates are usually too irregular to be used directly in pricing. Hospitalization portfolios, even when large, contain finite data, and some ages or causes may have limited exposure. The chapter therefore smooths the rates by Poisson regression. The likelihood can be interpreted as the likelihood of independent Poisson counts, with means equal to exposure multiplied by the corresponding rate. This provides a natural, generalized, linear modeling framework. Smoothing is important not only for aesthetics, but for tariff stability, reserve calculation, and credibility of the resulting age profile. The graph on this slide shows the transition rate from the active state to pregnancy-related hospitalization for women. The points correspond to crude empirical estimates, and the curve corresponds to the smoothed rates obtained by Poisson regression. The shape is very informative. The rate rises sharply from the early 20s, reaches its maximum around age 30, and then falls quickly. After age 45, it becomes essentially zero in the data. This reflects the fact that childbirth-related hospitalizations are concentrated over a relatively narrow age range. The empirical application uses data from a Belgian insurance company. For each insured person, the data include age, sex, hospitalization amount, duration, cause of hospitalization, and risk exposure. The available observations concern insured persons aged at most 65. Exposure is measured in days, using years of 360 days, and ages are evaluated from the year of birth. The chapter estimates crude rates and then smooths them to obtain a usable tariff basis. The chapter also notes that the return rate from pregnancy-related hospitalization to active status is approximately constant up to age 45. This implies that the duration of pregnancy-related hospitalization is treated as independent of age. The mean duration is about 7.15 days. For premiums, the pregnancy-related component creates a pronounced hump between ages 20 and 40. This explains why women's annual risk premiums are much higher than men's in that age range, before the age profile becomes dominated by ordinary hospitalization risk. The graph presents level premiums for women as a function of entry age under 3 annual deductible assumptions. No deductible, a deductible of €124, and a deductible of €248. The overall shape reflects 2 effects. First, entry age matters because coverage is assumed to continue until just before age 66. A woman entering later has a shorter remaining coverage period and faces a different balance between current and future risk. Second, the deductible lowers the premium because part of the annual cost is retained by the insured. The chapter emphasizes that annual deductibles are difficult to value analytically. They depend on the total reimbursable cost accumulated over the year, not only on the current state at one date. Simulation is therefore used. The actuary simulates many state trajectories over 1 year, generates sojourn times from the state probabilities, selects the next transition according to the relevant transition intensities, and discounts the incurred costs after application of the deductible. The level premium should also be interpreted together with annual risk premiums and reserves. For a woman entering at age 20 with an annual deductible of €248, the level premium is not sufficient to cover annual risk between ages 26 and 34, and again after age 53. These shortfalls are financed by surpluses collected at other ages. The reserve, evaluated just after premium payment, accumulates and is then released. This is the central financial logic of level premium hospitalization insurance. We have reached the final part of the presentation. The conclusion brings together the modeling, pricing, reserving, and estimation messages. The main lesson is that hospitalization insurance sits between non-life health insurance and life actuarial mathematics. It involves short-term claims, but these claims are embedded in a long-term contract with age-dependent risk, level premiums, and state-dependent reserves. Hospitalization insurance requires a dynamic multi-state framework because the key actuarial quantities are interdependent. Admission frequency, length of stay, benefit payments, deductibles, waiting periods, and medical cost assumptions cannot be separated cleanly. The Markov model gives a common basis for risk premiums, level premiums, and mathematical reserves. Risk premiums measure the expected annual cost at a given age. Level premiums redistribute this cost over the duration of the contract. Mathematical reserves record the difference between future benefits and future premiums, conditional on the state occupied by the insured. This state dependence is essential because an active policyholder and a currently hospitalized policyholder generate very different future cash flows. Contractual clauses have material pricing effects. Annual deductibles reduce premiums, but their impact depends on the loss level and must often be evaluated by simulation. Waiting periods for childbirth reduce the cost of pregnancy-related hospitalization with an effect that becomes negligible at high entry ages because childbirth becomes rare. The broader actuarial implication is that pricing cannot rely only on crude annual averages. It must combine transition rate estimation, smoothing, assumptions on future medical costs, simulation of realistic clauses, and reserve monitoring over the whole coverage period. The chapter therefore prepares the transition to the general study of life insurance contracts in a Markovian framework.